Hey, welcome investors to the 40 Finance channel. Today we're going to take a look at just how much the top tier of the stock market, aka the top stocks, have held up their performance over this recent weakness stretch that we're on. And from there, we're going to look at some fundamental metrics to try to answer the question, hey, like how long can these stocks keep holding up the market from a major crash? Because if they fall down, we're probably looking at much deeper pain, certainly over the short term. Kicking off here, I've got this chart. This is a 6-month chart. We'll also look at the 3-month and 1-month view. So here's the symbols that we have. We've got Dow Jones Industrial, that's the dark blue. That is price weighted. It's an oddball in the indexes. You got ARK in light blue, and that is a managed fund. Russell 2000, market cap weighted, but all small cap stocks. QQQ is market cap weighted, but it is the top 100 in the NASDAQ. SPY is S&P 500. It is also market cap weighted. And VTI, which is total stock market index, is also market cap weighted. When you look at the 6-month chart, obviously ARK and Russell 2000 have shown the most weakness. So small caps, obviously personified by the Russell, and then I'll argue that ARK is going to represent the high growth names, just for a lack of better example. But at the top, when you're market cap weighted, so when the top stocks or the largest stocks rise to the top, in the 6-month view, you're still positive. Switch it to the 3-month, and you're still positive in the market cap views, but you have negatives for Russell, you still have negatives for ARK, obviously. And the 1-month view, which really encaptures most of the volatility that we've seen, it does scroll back just a little bit to Thanksgiving, if I can get back that far. All right, how about this view? This is starting in November. And even in this view from November that sort of encompasses all the volatility that we've seen, if you just know that this line here, 0%, you know, everything above here is positive, and the only two that are below it are the Russell 2000 and, of course, the ARK fund. All right, so the reason I share that chart is just to kind of illustrate that if you're market cap weighted, aka leaning towards the top stocks in the stock market, which mostly shakes out to be stocks over $500 billion in market cap, then while you've seen or heard about stock market volatility, perhaps in forums or Twitter or whatever you use, the fact of the matter is it's not as bad as it looks if you're sitting at the top. Now, that's great news for today, but obviously all the damage that we've seen to high growth names, small caps, etc., has many of us wondering, you know, what would happen if Apple and Microsoft took a hit, you know, and how far down could they go, perhaps on the threat of interest rates or just some shock to the system that the market takes. So for this next bit, I'm going to stack up the top 5 or 6 stocks using SeekingAlpha. We'll go through the valuation metrics and just eyeball it and say like, hey, you know, how much room is there for a stock like Apple to fall if it had pressure on it? Okay, so using the SeekingAlpha stock comparison tool, I put in basically FAANGM, right? And in this case, I took out Netflix and added NVIDIA. Now, it's important to recognize this tool the way it stands today, which I think offers the best view for what we're doing on this video. It is limited to 6 tickers. So I had to make some choices. Obviously, we only have one Google. I booted Netflix, brought in NVIDIA, but we are missing Tesla. We'll take a look at Tesla very quick once we get through these. So going across the board, Facebook, Apple, Amazon, NVIDIA, Google, Microsoft, right? Makes a lot of sense. Market caps, the lowest one we have here is NVIDIA, and then after that, you're 900 billion or more from there. All right, now on ratings, You got three types of ratings in SeekingAlpha. One is their own sort of algorithm. The second is editorial pieces from SeekingAlpha authors, and then Wall Street. Okay, so on the Wall Street side, everybody in this group is still bullish. And then on the quant and SeekingAlpha authors, you got some neutrals, right? So not necessarily bad news here. I would just say maybe these stocks are a hold. Frankly, in this group, I don't know which of these stocks you would say, if you're going to buy it for 5 years, that it was a bad choice. But you got a couple that are coming in closer to maybe a hold rating. All right, now let's dig into the quant factor grade. So again, SeekingAlpha's own algorithm, and I do not know how it's stacked up, so take it with a grain of salt. On the valuation side, so remember the question here, will these stocks continue to hold up the market? Are they fairly valued? Not the greatest of news, at least from this algorithm standpoint, right? So you got D+, D-, F, D, and D-. So definitely on the negative side, insinuating in some regard that perhaps there's room to take off of these stock prices. All right, let's stop here at total return and try to think about the weakness that was in the market over the past month or so and how these stocks have fared. By the way, I'm going to take a second to call out too, if you're not aware, I am an affiliate of SeekingAlpha, and if you look in the description on this, I have a coupon link. My affiliate link is down there. Save you a substantial amount of money on a 1-year subscription if you're interested. All right, so on the 1 month side of total return, Facebook, Apple, and that's it. That's it on the positive. So these two have come out unscathed over the past 30 days. 3-month return, which would probably represent all of the weakness that dates back to Thanksgiving. Facebook down, Apple up, Amazon up barely, NVIDIA up dramatically, Google 1%, Microsoft 10%. So while this is good news for most of these stocks, it does make me worry a little bit, only because if you wanted to take a price of like the SPY or QQQ, you could make this argument if all of these were negative, right? You can make the argument, well, they've already been hit and we're still doing good. I don't necessarily see that, certainly across NVIDIA and Apple. All right, we'll skip past dividends and we'll go straight to valuation. And what we're really looking for here is forward, right? The past versus the present. So, and we're going to use GAAP accounting. And the most important thing is going to be this forward PE, because that's tied into the EPS projections, right? We want to make sure that we're staying at a reasonable value, and we're going to keep one eye on last year's PE, aka the current PE. In an ideal situation, the PE goes down over time, and the reason ideally it goes down over time is because the company produces more profits, aka earnings. So let's do the eyeball. Current for Facebook, 23.79, goes up ever so slightly, but perhaps more importantly, looking flat for next year. Apple goes down a little bit, which is a good sign for Apple, but this is hardly anything beyond flat here. Okay, so I would argue perhaps very little room to run in Apple that's left, because you also have this in the 30s, and if you're not aware, Apple has historically not traded anywhere near 30, usually in the 20s, if not teens. All right, on the Amazon side, going from a 63 to an 80, that would definitely insinuate some room to come down off Amazon. Now, some of you know I own Amazon shares. I'm not particularly worried about this right now because their capital build out is something that's going to pay off, 2 to 5 years from now, probably sooner than most people think. But here in the short term, to answer our question, will Amazon be part of the arch that supports the market? I'm not sure. They could actually take a hit and it wouldn't surprise me. How about NVIDIA? GAAP PE of 86 right now. It's going in the right direction. It's going down. However, it is a chip stock. And typically chip stocks don't trade at this valuation. I think historically for NVIDIA, you'd want to get down into the 60s, if not 50s, but some of that depends on interest rates. I'm going to go ahead and say NVIDIA has room to lose some more points off of its stock price. Okay, Google. Quite honestly, I think Google's the healthiest of the bunch. The only thing I'll call out here is that it's not calling for significant EPS growth. The jump down from 26.54 to 25.45 isn't really that significant. The one thing you do have, though, here is a very nice valuation at around 25. And then Microsoft. I think Microsoft has a little more room to pare down. 35 to 33 is good news for the EPS. It just means it's going up. However, a quick look at Microsoft historicals, you're going to see a stock that, generally speaking, is not trading in the 30s. Now, same exercise very quickly on GAAP, price to earnings growth. Unfortunately, we're going to have to compare it against non-GAAP price to earnings growth. But it's the story that we have to be concerned about. So the growth of earnings, you want this to be lower, by the way. Facebook here, it's going up. Apple, obviously going up. And we've got Amazon going up. NVIDIA going up. Google going up. Microsoft going up. So theoretically, this metric, although it is non-GAAP to GAAP, this metric is telling us that the valuation of the stock in the short term is sort of going in the wrong direction compared to where it stands today. And price to sales, all these stocks have earnings, so I don't know how important this is, but we're staying about flat with Facebook this year to next, about flat with Apple, same for Amazon. NVIDIA's coming down, which is a good sign. Google's coming down, same with Microsoft. But again, I would emphasize that these companies all have EPS, and that's where the root of their value is going to come from. All right, so we talked about price to earnings growth. We talked about EPS growth. Let's see where it stacks up on the revenue side. So we have revenue growth year over year, and then projected revenue growth. All right, Facebook, 42, 25 looking ahead. Apple, 33% in the rearview mirror, 13% out the windshield. Amazon, 31 down to 25. NVIDIA, 64 to 42. Google, 39 to 22. Microsoft, 19 to 16. Every single one of these stocks will have slower revenue growth, more than likely, in 2022. That takes a lot of momentum away from stocks, and it could lead to a little bit of a shakeup around earnings time. If they come out and project revenue and put a number down, it has the opportunity to spook the market a little bit. And with these names, they're not going to go to zero, but perhaps their valuation comes down 5 or 10 points. And that, of course, would drag the whole market down. All right, what else do we have here? Looking at short interest, I can't imagine. These companies are so gigantic, it would take forever to short them. Nobody has that much money. Not a lot of short interest, which is good. I just say that if you're going to short a stock, you're probably not going after the $1 trillion market cap ones. Here's our EPS revisions. Up is a positive for momentum, and then obviously down every time there's going to be, the headline that says Billy lowers his EPS projection for Facebook. It's going to be considered a negative headline. So Facebook, I'll say 2 positives, 25 negatives. Apple, 13 positives, 8 negatives. Amazon, 36 negatives, 3 positives. NVIDIA, all positive. Google, approximately the same. Microsoft, pretty good ratio there, 19 to 3. So what do we got? 1, 2, 3 going positive, and then we have 2 going negative, and then 1 I'm just going to say is, arguably flat. But you know what? The problem is with 2, if these guys do fall over a little bit next year, you know, it's 2 out of 6. So that's 33% of the stocks in our sort of market cap umbrella that people are picking against from an earnings standpoint. All right, before I jump into my final thoughts here, here's Tesla. We hit on all those metrics. Remember, I couldn't compare it because the stock comparison only takes 6 names. And one of the reasons I omitted Tesla is because it honestly, it just fails from a valuation score. And that's a lot of what I do on this channel. So because it was F's across the board, I think it's pretty safe to say that if the market does respond to valuation, which it seems to be getting there slowly, Tesla is certainly at risk to lose a portion of their stock price and market cap in a pressure environment. All right, so direct answer. How long can FAANGM plus T hold up the stock market? You know, I would say that structurally, it's going to hold up pretty well. Short term, in my opinion, based on a lot of the metrics that we just looked at, I do think it has more room to run down. Now, I say that and I think about the real top-heavy ETFs, right? Most notably QQQ, which is one that I'm currently investing in, buying at very small bits, cross time as I see weakness. It would not surprise me. The QQQ is at about 380, 385 today. Does it get down another 10% to 350 levels? That wouldn't surprise me. I'm just going to put it that way. And honest to goodness, if that happened, I would feel very, very good about the future price action for QQQ if I was able to get it at the 350s or perhaps, you know, a touch below. Frankly, anything in that 350 area I think is a good buy. I'm buying today in the 380s, just one little bit at a time. All right, investors, share your thoughts below. Do you think these mega cap stocks will continue to shield us from the pain that we've seen in smaller cap stocks? Let me know your thoughts below. As always, please give a like to the video, share with your friends, subscribe to the channel. Really appreciate your support. We'll see you on the next video.